January 16th, 2025. Mark this date. Not because someone told you to, but because a mathematical line was just crossed. A line that cannot be uncrossed. In 40 years of tracking markets, this pattern has appeared only 3 times, 1979, 2008, and now. Each time, fortunes transferred in weeks, not years. 700 million ounces, gone. Government debt, $100 trillion. Silver still trading like nothing changed. But something has changed. The supply everyone assumed would last forever is disappearing, and when the market realizes what is already true, the adjustment will not be measured in percentages, it will be measured in multiples, and it begins right now. Welcome to Currency Analyzer, where we examine the economic realities that shape your wealth, whether you acknowledge them or not. If you have been observing markets for decades, if you remember when currencies actually held their value, if you understand that real wealth is not built on headlines, but on mathematics, then take a moment. Press that subscribe button, not for entertainment, but because the analysis here is designed for serious minds, minds that recognize opportunities others overlook. Now, tell us, where in the world are you watching this from today? North America, Europe, Asia, the Middle East, perhaps somewhere else entirely? Drop your location in the comments, because what unfolds from this point forward is not limited by geography. It is driven by mathematics, and mathematics respects no borders. Let us begin. An analyst sits at his desk in Lower Manhattan. Outside, the city moves at its usual frantic pace. But inside this quiet office, a man with 40 years of market experience stares at numbers that tell a story most people will never see. He is not excited. He is not panicking. He simply recognizes something, a pattern. The same pattern he witnessed twice before in his lifetime. And both times, it changed everything. The date on his screen reads January 16th, 2025. To most people, this date means nothing, just another Thursday in the middle of winter. But to him, this date represents a threshold, a mathematical point of no return. He leans back in his chair. His eyes move from the screen to a framed photograph on his desk. The photograph shows him younger, standing outside the New York Stock Exchange in 1979. That was the first time he saw this pattern. Back then, silver was trading at $6 per ounce. Nobody cared about silver. It was boring, forgotten, irrelevant. Then something happened. Within months, not years, months, silver climbed to $50 per ounce, an 800% increase in less than a year. Fortunes were made, wealth transferred from those who ignored the signs to those who understood the mathematics. He was one of the few who understood. The second time came in 2008. The world was collapsing. Lehman Brothers failed. Stock markets crashed. Real estate values evaporated overnight. Everything fell together, including silver. But then, something strange happened. For the next 3 years, while the financial system tried to rebuild itself, while central banks printed trillions of dollars, silver quietly climbed from $9 to nearly $50 again. Another 500% move, another massive wealth transfer, and once again, most people missed it entirely. Now, he sees the same pattern forming for the third time, but this time, the setup is different. This time, the mathematics are more extreme. He opens a file on his computer. The file contains data going back 45 years. In 1980, silver reached its all-time high of $50 per ounce. That was 45 years ago. He does a simple calculation in his head. 45 years of inflation, 45 years of currency expansion, 45 years of global economic growth, and silver today trades at $30. $30, still below its price from 1980. He pauses, letting this reality sink in. There's no other major asset on Earth with this profile. None. Real estate in major cities has increased by 500%, some areas even more. The stock market has multiplied by thousands of percentage points. Even gold, silver's sister metal, has broken through to new all-time highs multiple times. But silver remains trapped in the shadows, forgotten, ignored, treated like it does not matter. He opens another chart. This one shows what silver should be worth today if it simply kept pace with inflation since 1980. The number on the screen reads $140 per ounce. Not $30, $142, just to match its historical purchasing power. He sits back and considers what this means. This is not normal market behavior. This is not a typical asset price cycle. This is suppression. Whether intentional or structural does not matter anymore. The result is the same. A massive gap has opened between fundamental value and market price. And gaps like this, eventually close, not gradually, not politely, violently. He has seen this movie before. He remembers the early 2000s when everyone declared commodities dead. Technology was the future, they said. Physical assets were relics of the past, they said. Nobody wanted oil, copper, agricultural products. The narrative was so dominant, so universally accepted, that questioning it seemed foolish. Then reality reasserted itself. Oil went from $20 to over $140. Copper tripled. Agricultural products exploded higher. The exact same pattern. Years of neglect, structural underinvestment, a narrative so powerful that it blinded people to mathematical reality. And then, suddenly, violently, the market corrected. He sees silver in exactly the same position today, but with one critical difference. The global debt situation is far worse now. He pulls up another screen. Global government debt, $100 trillion. The number is so large, it has lost all meaning to most people. Nobody can truly comprehend it. And more importantly, nobody can repay it. Not through taxation, not through economic growth, not through spending cuts. The mathematics simply do not work. There's only one solution governments have used for 3,000 years. Debase the currency, create more units. Make the debt smaller by making each unit worth less. This is not theory, this is observable reality happening right now. And silver, priced in these debasing currencies, remains historically cheap. He closes his laptop. He has seen enough for today. The mathematics are clear. The pattern is forming. The asymmetry is extreme. What happens next is not a mystery. It is history preparing to repeat itself. And January 16th, 2025, will be remembered as the day the threshold was crossed, the day everything changed, whether anyone was paying attention or not. A conference room in Lima, Peru, 3,800 meters above sea level. The altitude makes every breath harder, but it is not the thin air that troubles the mining executive sitting at the head of the table. It is the numbers. He stares at a spreadsheet projected on the wall. Annual silver production, 800 million ounces. The same number he saw last year, and the year before that, and the year before that. For an entire decade, this number has barely moved. Not up, not down, just flat. But something else on that spreadsheet has changed dramatically. The requests. 3 years ago, buyers would place orders casually. We need 50,000 ounces next quarter. Standard procurement language. Relaxed timelines, no urgency. Today, the language is different. We need guaranteed supply contracts, multi-year commitments, no interruptions permitted. The tone has shifted from requests to demands. He recognizes what this means. His company operates mines that were discovered 30 years ago. Back then, the ore was rich. Every ton of rock pulled from the earth yielded generous amounts of silver, profitable, efficient, sustainable. Not anymore. Each year, they dig deeper. Each year, the ore grade declines. Each ton of rock now yields less silver than the previous year. The costs keep climbing. Fuel, labor, equipment, environmental compliance, everything more expensive, everything taking longer. And across the entire industry, nobody is finding new deposits. Not the significant kind, not the kind that changes production forecasts. He thinks about the exploration budgets. 10 years ago, major mining companies invested billions searching for new silver, drilling in remote locations, testing geological formations, taking risks. Today, those same companies prefer buying back their own stock. Returning cash to shareholders. The calculation is simple. Searching for new silver takes too long. 10 years minimum from discovery to production. The political risk is too high. Governments change, regulations shift, permits get delayed. The return is too uncertain. Why invest billions in something that might produce silver a decade from now? When you can boost your share price today, so exploration budgets get cut, production stays flat, and demand accelerates. The executive clicks to the next slide, a breakdown of where silver goes after it leaves the mine. 70% disappears into industrial applications. This number stops him every time. 70%. Not jewelry that can be melted down and resold. Not coins that investors trade back and forth. Industrial consumption, permanent, irreversible, gone forever. He thinks about a solar panel. A homeowner in Texas installs solar panels on his roof. Inside each panel, thin strips of silver conduct electricity. That panel will sit on that roof for 25 years, maybe 30. Then one day, it stops working. The homeowner calls a company to remove it. The old panel goes to a landfill. And the silver inside, the silver is embedded in the panel structure. Fragments so small, so dispersed, so thoroughly integrated, that extracting them would cost more than the silver is worth. So it stays there, in a landfill, buried, lost, never returning to the market. He clicks again. Electric vehicles. A factory in Germany produces electric cars. Each vehicle contains nearly 1 ounce of silver. Wiring, circuit boards, sensors, control systems, all require silver's superior electrical conductivity. That silver gets locked inside the vehicle. When the car reaches end of life in 15 years, Some parts get recycled. Steel, aluminum, copper, glass. But the silver embedded in complex electronic systems, too difficult, too expensive, too scattered to recover, gone. Another click. Smartphones, 2 billion produced annually. Each contains a tiny amount of silver. Individually, insignificant. Collectively, massive. And these phones get replaced every 2 years, discarded, thrown away. The silver inside scattered across the planet in landfills and electronic waste dumps, never coming back. This is not a temporary phenomenon. This is not something that reverses when prices rise. This is permanent supply destruction. And it is accelerating. The executive knows why. Governments around the world made commitments, climate agreements, carbon reduction targets, green energy transitions. These are not suggestions. These are mandates, backed by trillions in subsidies, enforced through regulations. Solar installations must increase by double digits every year. Electric vehicle sales must multiply over the next decade. 5G infrastructure must be built in every major economy. All of it requires silver. None of it is optional. None of it can be delayed. None of it can be substituted easily. Engineers tried. Research teams spent years testing alternatives. Copper, aluminum, graphene, various alloys. Nothing matches silver's unique combination of properties. Highest electrical conductivity of any element. Highest thermal conductivity. Superior reliability in extreme conditions. In critical applications, there is no substitute. So industrial consumers compete for available supply. His phone vibrates. A message from a procurement officer in South Korea. Client demanding immediate delivery. Cannot wait until next quarter. Production lines will stop. What can you guarantee? He reads it twice. This is the third message like this today. Yesterday, there were 5. The pattern is clear. Industrial buyers are no longer flexible. They cannot afford production delays. Their customers have zero tolerance for interruption. They need silver, physical silver, now. Not next month, not next quarter, now. And they will pay whatever it costs. He looks back at the spreadsheet on the wall. 800 million ounces produced annually. But global demand last year, 1 billion ounces. The year before, 1 billion ounces. The year before that, 1 billion ounces. 3 consecutive years. 200 million ounces more consumed than produced. Every single year. That is 600 million ounces total. Gone from stockpiles. Reserves built over decades. Depleted in 3 years. He does the simple calculation. If demand continues at current pace, if production stays flat, the remaining stockpiles will be exhausted. Soon. Very soon. And then what? What happens when an industrial buyer demands delivery? And the silver simply does not exist? What happens when production lines stop because metal cannot be sourced? What happens when the paper markets promise delivery, but the physical vaults are empty? He closes his laptop. The answer is obvious. The price will adjust, not gradually, not through normal market mechanisms. Because when supply disappears and demand cannot be reduced, price is the only variable left, and it will move fast. Washington, D.C. A basement office in the Treasury building. No windows, fluorescent lights humming overhead. A place where numbers tell stories that politicians never want to hear. The official sitting here is not elected. He does not give speeches. His name never appears in newspapers, but he sees everything. Every dollar borrowed, every interest payment made, every projection that stretches into a future that becomes darker each quarter. On his screen, a spreadsheet. Not the one shown to Congress, not the one released to the public. The real one, the one that keeps him awake at night. Total federal debt, $36 trillion. He remembers when crossing 1 trillion felt impossible. That was decades ago. Now, the number is so large people cannot comprehend it anymore. Their brains simply shut down when they see it. 36 trillion might as well be 36 billion or 36 million. The human mind was not designed to grasp numbers at this scale, but he understands what it means. He clicks to the next tab. Annual interest payments, $1.1 trillion. Just the interest, not paying down the principal. Just servicing the debt, $1.1 trillion every single year. He does a quick comparison. The entire defense budget, $850 billion. All spending on education, $80 billion. Infrastructure, $150 billion. Veterans Affairs, $300 billion. The interest payment on the debt is now larger than all of these combined. And it grows every month, every time the Treasury issues new bonds, every time interest rates tick higher, every time another government program requires funding, the debt compounds. He leans back in his chair. There's a question nobody in this building wants to ask publicly. How do we repay this? He has run the scenarios, all of them. Option 1, massive spending cuts. Cut government spending by 30%, 40%, maybe 50%. Eliminate entire departments. End social programs immediately. Stop infrastructure projects. The economy would collapse within months. Unemployment would explode. Tax revenue would plummet. The debt would actually grow faster. Option 1 is not possible. Option 2, dramatic tax increases, double income taxes, triple corporate taxes, create wealth taxes, transaction taxes, property taxes, confiscate everything above a certain threshold. The result would be immediate capital flight. Businesses would relocate overnight. The wealthy would renounce citizenship. Economic activity would freeze. Tax revenue would collapse. Option 2 is not possible either. Option 3, grow the economy fast enough to outpace the debt. Achieve 6%, 7%, maybe 8% GDP growth for decades. But the US economy has not sustained 4% growth in years. Structural problems prevent it. Aging population, declining productivity growth, massive existing debt burden choking investment. Option 3 is a fantasy. That leaves only one option. The option that every overleveraged government in history has chosen. The option that politicians never admit publicly. The option that happens slowly, quietly, inevitably. Print, inflate, debase. Make the debt smaller by making each dollar worth less. He clicks to another file. A chart showing US dollar purchasing power since 2000. The line drops steadily. What cost $1 in 2000 requires nearly $2 today. The currency has lost 45% of its value in just 25 years. But the real acceleration happened recently. Between 2020 and 2022, the money supply expanded by 40%. In just 2 years, 4 out of every $10 currently in existence were created in that short window. This was not economic stimulus. This was currency dilution on a scale rarely seen outside of wartime, and it continues, quietly, through mechanisms most people never understand. Quantitative easing, balance sheet expansion, bond purchases, all different names for the same thing. Creating money that did not exist before. Across the Atlantic, a similar scene unfolds. Frankfurt, Germany, European Central Bank headquarters. Another official stares at another impossible equation. Eurozone government debt has crossed sustainable levels years ago. Italy, Spain, France, Greece, all carrying debt loads that cannot be serviced at normal interest rates. If rates rise to 5%, 6%, levels that would be considered normal historically, these governments default. Pension systems collapse. Banks holding government bonds become insolvent. The entire European financial system unravels. But if rates stay at 1%, 2%, artificially suppressed levels, inflation destroys purchasing power. Savings evaporate. Workers watch their wages buy less each year. Social unrest builds. There's no good choice. Only a decision about which crisis to face. So the central bank does what bureaucracies always do. Delay. Use technical language that obscures reality, adjust policy in tiny increments, hope something changes, but nothing will change. The mathematics are fixed. The debt cannot be repaid honestly, so it will be repaid dishonestly, through inflation, through debasement, through the slow theft of purchasing power. The official in Frankfurt knows this, the official in Washington knows this, every central banker in every major economy knows this, but they cannot say it because the moment they admit it, the moment the public understands what is happening, confidence collapses, and confidence is the only thing keeping the system functional. In Tokyo, the pattern is even more extreme. Japan's government debt exceeds 250% of GDP, a ratio so high it should be impossible. Interest rates have been held near zero for decades. The Bank of Japan owns nearly half of all government bonds. They print money to buy their own government's debt. A circular system that should have collapsed years ago, but it continues, year after year. The economy barely grows. The debt keeps expanding. The yen keeps weakening. And life goes on? This is the future for all fiat currencies. Not sudden collapse. Slow erosion, purchasing power declining gradually enough that people do not revolt, but fast enough that debts become manageable in nominal terms. History shows this pattern repeatedly. Ancient Rome reduced the silver content in coins until they contained almost none. The currency became worthless. The empire collapsed. Weimar Germany printed to pay war debts. Within months, workers needed wheelbarrows full of cash to buy bread. Life savings destroyed overnight. Argentina repeated the cycle multiple times. Venezuela turned the wealthiest South American nation into an economic disaster zone. Zimbabwe printed currency notes with trillion-dollar denominations that could not buy food. The pattern never changes. Governments spend beyond their means, borrow to cover the gap, debt compounds, until honest repayment becomes impossible. Then they print, not because they want to, because mathematics leaves no alternative. And in every case, throughout all of history, those holding physical assets survived. Those holding paper promises did not. The official in Washington looks at his screen one more time. 36 trillion in debt, growing by trillions more each year. interest payments consuming more of the budget annually, no political will to cut spending, no economic capacity to grow fast enough, no mathematical path to honest repayment. Only one solution remains: debase the currency, and silver, priced in that debasing currency, still trades like none of this matters, still valued as if governments are solvent, still priced as if currency stability is guaranteed. But it is not guaranteed. Nothing is guaranteed, except the mathematics. And the mathematics are screaming. London, 3:47 a.m. A risk manager cannot sleep. He sits in his home office, laptop open, reviewing data that should not look like this. He works for one of the largest commodity exchanges in the world. His job is simple: monitor risk, identify problems before they become crises, ensure the system remains stable. But the data on his screen tells him something is wrong. Very wrong. On the surface, everything appears normal. Silver futures, trading volume, within historical ranges. Open interest, stable. Price action, orderly. Bid-ask spreads, tight. Everything looks perfectly fine. But he's not looking at the surface anymore. He's looking deeper, at something most traders never pay attention to: physical delivery requests. 3 years ago, these requests were routine, predictable. Maybe 2% of all contracts resulted in actual metal delivery. The other 98% settled in cash or rolled forward to the next month. Standard commodity market behavior. Traders speculating on price movements, not demanding physical metal. But over the past 18 months, something changed. Delivery requests started increasing. Not dramatically, just consistently, month after month, quarter after quarter. More participants demanding actual metal instead of cash settlement. Last month, delivery requests hit 8%. This month, 11%. He stares at the number. 11% does not sound alarming, but in commodity markets, it is massive. The system is designed for 2%, maybe 3% physical delivery. The entire structure, the leverage, the margin requirements, the vault capacity, all calibrated for a world where almost nobody takes delivery. But that world is changing, and the system is not built for this. He opens another file, registered inventory at COMEX, the amount of silver actually available for immediate delivery. The number has been declining for 2 years straight. Not slowly, rapidly. Silver is leaving the vaults, being shipped to India, to China, to industrial facilities that need the metal for production. And it is not coming back. He calculates the ratio: total open interest divided by available physical inventory. The number makes him uncomfortable. For every ounce of actual silver in the vault, there are 73 paper claims against it. 73. This works fine when nobody demands delivery, but when they do, when multiple parties simultaneously demand physical metal, the math breaks. He remembers March 2022, the nickel market, London Metal Exchange, a market that had functioned smoothly for decades. Then, one morning, everything stopped. Physical delivery requests exceeded available supply. The price spiked 250% in hours. Traders who had sold nickel they did not own faced unlimited losses. The exchange had two choices: allow the market to function and watch major participants default or suspend trading entirely. They suspended trading. Billions in losses. Contracts canceled. Lawsuits that continue today. Trust in the exchange permanently damaged. That was nickel. A metal with limited public visibility, relatively small market participation. Silver is different. Silver markets are larger, more global, more interconnected. If silver experiences a delivery crisis, the implications would be catastrophic. Across the world, another crisis is building simultaneously. Seoul, South Korea, 4:00 p.m. local time. An executive at a major electronics manufacturer ends another frustrating call with his procurement team. His company produces components for electric vehicles. Production schedules are locked in 6 months in advance. Customer contracts carry penalties of $500,000 per day for delays. He cannot afford disruption. He needs silver, physical silver, delivered to his facility, not a futures contract, not a paper promise, actual metal that his engineers can use in manufacturing. His procurement officer just gave him disturbing news. Premiums for physical silver have doubled in 3 months, not the price quoted on financial exchanges. The actual cost to secure real metal for delivery. 3 months ago, they paid $2 per ounce above spot price. Today, dealers are quoting $5 per ounce premiums. Some are quoting $7. And the delivery times keep extending. Used to be 2 weeks, then 4 weeks. Now dealers are saying 6 to 8 weeks. Some are requiring 50% deposits up front. Others have stopped taking new orders entirely. We cannot guarantee supply right now. Check back next month. This is how physical shortages begin, not with dramatic headlines, not with price explosions on trading screens, with friction. Quiet friction that most people never see. Longer wait times, higher premiums above spot price. dealers becoming selective about which orders they accept. He thinks about his production line. If silver does not arrive on schedule, manufacturing stops. Customer penalties trigger immediately. Contracts get canceled. His company's reputation suffers permanent damage. He cannot let that happen. So he does what every industrial buyer in his position is doing. He pays the premium. He accepts the extended delivery time. He secures the metal, whatever it costs. And the available supply shrinks further. Meanwhile, in New York, a trader sits at his desk completely unaware. He looks at silver futures on his screen. Price, 30.15 per ounce. Volume, normal. Liquidity, excellent. He can buy or sell millions of ounces with a few keystrokes. Everything appears healthy. He has no idea that the physical metal backing those contracts is draining away. No idea that industrial buyers are competing for shrinking supply. No idea that delivery requests are overwhelming vault capacity. The screen shows him an illusion, an abstraction. A promise that somewhere, somehow, physical silver exists to back these trades. But the physical market tells a different story. London vaults have lost 30% of silver holdings in 2 years. COMEX registered inventory approaching multi-decade lows. Shanghai vaults being emptied by Chinese industrial buyers. The metal is disappearing. And the paper market continues trading as if supply is infinite. This is the dangerous disconnect created by derivative markets. They provide the appearance of liquidity. They create the impression that supply is abundant. But you cannot manufacture a solar panel with a futures contract. You cannot wire an electric vehicle with a paper promise. You cannot build a semiconductor with a derivative. Industrial consumers need real metal, and they are taking it faster than mines can produce it. The risk manager in London closes his laptop. He knows what comes next. He has studied market history, oil in the 1970s, agricultural commodities in 2008, nickel in 2022. The pattern is always identical. Years of paper market dominance. Prices remaining stable, despite deteriorating physical fundamentals. General market complacency. Everyone assuming the system will continue functioning as it always has. And then one morning, everything changes. Not because new information emerged, because the market finally acknowledged what was already true. The inventory was gone. Physical supply could not meet demand, and price had to adjust immediately, violently, to reflect reality. Silver is approaching that moment. 3 consecutive years of supply deficits. 700 million ounces consumed beyond production. Stockpiles depleted. Industrial demand accelerating. Government mandates ensuring consumption continues. No substitutes available. When the last available ounce is claimed. When an industrial buyer demands delivery and the metal simply does not exist. When the exchange faces the choice between default and emergency suspension. The paper price will catch up to physical reality. Not in percentage moves, in multiples. 2 times current price, 3 times, perhaps more. All compressed into days, maybe weeks. To those watching screens, it will appear sudden, unexpected, chaotic. But to anyone tracking physical flows, to anyone understanding the mathematics, it will be the logical conclusion of years of structural deficit. January 16th, 2025. The threshold has been crossed. The awareness is spreading. Most people will still ignore it. That is precisely why the opportunity exists. Wealth does not transfer during calm times. It transfers during dislocations, when paper abstractions diverge too far from physical reality, when the majority believes one thing, while mathematics prove another. When the gap finally closes, violently, those positioned in physical assets survive. Those holding paper promises do not. The window remains open, but it is closing. And when it closes, your screen will tell you what happened. But by then, the opportunity will have already transferred to those who understood the physical market and acted while others hesitated. The breaking point is not coming. It is here. The only question remaining, which side of this transfer will you be on? This is Currency Analyzer, where we examine the mathematics that shape wealth, whether markets acknowledge them or not. If this analysis provided clarity, if it revealed patterns you had not considered, share it with someone who needs to see it, not for entertainment, for preparation. The transfer is coming. Mathematics guarantee it. History confirms it. And January 16th, 2025, marks the point where everything changed.